We are with John Taylor, of course, of the Taylor Rule, a lot of fame in the economics profession, and he helps put together this conference, brings together Fed officials and economists from all over. One of the things everybody's talking about, today's labor report, 3.9% unemployment, and yet on a year-over-year basis, wages go down. In the literature, how is that supposed to happen?
The literature isn't perfect on these month-to-month changes, and you can't track it that closely. But you are beginning to see some improvements in wages. It's not necessarily tied to the unemployment rate, but I think that's basically tied to productivity and what the policies are. They're going to raise productivity of workers, which will raise wages.
Which is outside the purview of monetary policy, correct?
It is. The real wages are outside the purview. Real wages, how much wages increase compared to prices, that is. Of course, wage inflation, price inflation is monetary policy's role.
In 2009, you were among a group of people who thought that the stimulus package at that time would lead to very high accelerating inflation, which didn't happen. We've got a stimulus package now with 3.9% unemployment, and we're not seeing inflation really accelerate. Does that suggest that either you were wrong in your diagnosis or something has changed in inflation dynamics?
I think my main concern about the stimulus package, actually 2008 and 2009, is it wouldn't get the economy moving. It really would be saved, and it wouldn't work at the state and local governments. That turned out to be pretty clearly true, I think. The inflation effects have been debated for many reasons. It's not really so much the stimulus package as monetary policy. And I think the Fed has to think about inflation. I worry sometimes if it goes below 2, it's like the end of the world. It's not the end of the world if it's 1.6. And I think the Fed has to think about that as they begin to normalize policy.
But I wonder, the inability to generate inflation and the fact that we have gone so long with inflation so low, not deflation, but low inflation, does that suggest that maybe your rule, the Taylor Rule, needs to be somehow tweaked?
Well, they haven't been following the Taylor Rule during this period. I think that's very significant. When they did, things worked quite well. The economy was stable. We had a long expansion, sometimes called the Great Moderation. They got off it roughly 2003, 4, and 5. The good news is they're coming back, and I think we're going to see some improvements. Already have seen some improvements in the economy as they become more rules-based.
Well, the idea of the output gap, which is in your formula, being much lower than it used to be, does that change the way the Taylor Rule gets applied?
No, it's remarkably similar over time. The main thing that's changed is the notion of what the equilibrium interest rate is, sometimes called R-star. Big debate about that. John Williams here at the conference has written about that. There's the debate about that. That's the largest issue in the Taylor Rule.
Have you played around with different versions of that?
Oh, of course, as the Atlanta Fed and many other central banks. I think there's uncertainty about this. The Fed has reduced their estimate from 4 to 3, where the long-term, short-term federal funds rate is going. But I think there's a lot of uncertainty, and I wouldn't be surprised if they begin to revise their estimates up before too long.
Given that, what I'm kind of getting at here is if you're looking at the Taylor Rule or if you're looking at discretionary policy, how much of a risk do we run if we don't know these things in a policy mistake?
Well, it's very important to have a good estimate, whether you're using rules or not rules. I think since rules or strategies, it's easier to think about the impact of these things on the decisions. Otherwise, what difference does it make? The advantage of what the Fed's doing recently, which is, I think, moving and more talking about policy rules, is that you can see the implication. If they raise, if the current FOMC members raise that, you can see the impact on the current rate.
Do you think that the forecast as they have outlined right now is appropriate?
As far as I know, they're still a little cautious about the increase in potential GDP growth. And I think the tax policy changes, the regulatory changes, stand a good chance of raising the longer-term growth rate, certainly above that old 2%, which we've seen since the recovery began, and we're seeing some better news recently. I think that's probably the question that many people are raising, and I think the news will be good in that dimension.
Well, the question about the stimulus proposal is, since the tax law came into effect, business spending has gone down, consumer spending has been weak. So people say, when? When do we see a result?
The tax reform aimed to reduce the tax on business investment, all kinds of investment, and that will be the way productivity rises. Workers have better capital, more capital to work with, and therefore be more productive. That doesn't occur overnight. We've had these long-term trends, declining productivity, and so I think you will see an increase in productivity, but it's not going to be overnight. And you've seen some things, the stock markets move, you see some 3% growth rates the last part of last year. Those things are the signs you're going to see. It won't be instant, but of course the unemployment rate 3.9% is a number of people are looking at.
Do you think that we're going to have inflation result from this, the kind of inflation that you feared back in 2009?
I think if the Fed does the right job of getting back on track with monetary policy, the risks of that are low. The tax reform mainly reduces tax rates. It doesn't change the long-term budget picture, which is a concern. And I think ultimately that has to be addressed through reduction in the growth of spending. So the tax reform, and I'll call it tax reform, leaves tax revenues as a share of GDP not much different than what they were otherwise.
You mentioned cutting spending. You have to go into entitlements, don't you?
You have to cut the growth of spending, there's no question about it. That's where the acceleration is coming from. I think there are good ways to do that. Economists, people here at this conference have thought about ways to do that. It's how to get that through the system. And I think, quite frankly, right now there needs to be more attention to how do we improve our entitlement system, how do we make it better for people, and how we prevent it from just exploding in terms of GDP.
Well, I wanted to ask you about the system because you've served both inside and outside it. You've been an administration official and you've been an academic looking at this. Does our system work anymore for the economy of the United States?
It can, and I think it's beginning to. There are ups and downs in policy. I think policy was terrible in the 70s, got better in the 80s and 90s. It's sort of turned away in more recent years, and I think if it comes back, you'll see the responses. And so we live in a democracy. People have different views. You have to debate this. It doesn't change on a dime, but I think you do see changes, and they're quite noticeable in the numbers, and that's the promising thing.
Do you think this administration has a holistic view, an economic philosophy, or is it sort of doing things ad hoc?
I look at it at pieces. As I meant, the tax reform seems quite promising. A lot of the regulatory reform seems promising. The trade stuff is a concern, and the budget stuff is a concern. So we'll see how those latter two work out, but the first two seem to be quite positive.
Yeah, on trade, overnight the U.S.-China talks seem to have disappointed. How much of a concern do you have about trade wars and the effect on the U.S. or global economy?
Well, you have to worry about it. They do happen in the past. I think the most important thing is to be specific about what the other countries should be doing. What should China be doing with respect to intellectual property, with respect to ownership control? And I think if the U.S. is explicit about that in the talks, I think they will be, you'll see a better outcome than otherwise would occur if there's a trade war.
Jay Powell, your marks for him in his debut as chair?
Yeah, I think he's doing well. His testimony in the initial part of January worked quite well. He talked a lot about the importance of systematic policy and policy rules. He emphasized what had done in the last year of Janet Yellen's term. And I think that's promising. The normalization seems to be going well. The balance sheet adjustment seems to be going well. So I think it's good.
Is it time now for the Fed to rethink its policy regime, its reaction functions?
I think they're in the process of doing that. It's not so much rethinking the reaction function, it's getting back to the reaction function that they've always thought about. What's promising is they talk about it a lot. You can see it in the report, you can see it in the speeches, the discussion of policy rules, such as the Taylor rule, but there are others, strategies, where we are going, the dots, all those things have to do with communications about where policy is, and I think that's going.
Well, we know as the discussion goes on, John Taylor will be part of it. Thank you very much for joining us today.